Another detail you should know about puts is that they trade in a separate market from the stock market, and their price is determined by things called the Greeks, which is basically the math associated with how options work or how options get priced. There's technically 32 first, second, or third order Greeks that influence or determine option prices, but we're only going to be talking about 5, because really the 5 Greeks are really all anyone ever talks about, and they're the most important. The first of the Greeks and the most important is called delta, and delta looks at the relationship between the movement in price between the underlying stock in this case and the movement of the underlying option. So think about it like this: if delta is trying to answer the question, if Bed Bath & Beyond drops by $1, how much is the put option on Bed Bath & Beyond going to rise in price? And the number ranges between 0 and 1. Let's pick an example of 0.7. That means on a put option, which will go up in price when the shares of Bed Bath & Beyond drop, right? It's your insurance policy against a share price fall in Bed Bath & Beyond. Let's say that there's a 0.7 delta on a particular put option on Bed Bath & Beyond. If Bed Bath & Beyond drops by $1, that means that put option is going to rise by 70 cents. Okay, it doesn't influence what happens as an insurance policy, right? You still have the right, in the case that I gave, or in the example I gave, to sell the Bed Bath & Beyond for $60, but that's basically it in a nutshell. The delta tracks the relationship between price movement of the underlying stock and the actual option. It's relevant to option traders, less relevant to people who want to do the conservative married put strategy. The next Greek is called gamma, and what it does is it measures the change in delta over time, which I guess makes it a second order function. What gamma is about is determining how sensitive delta is over time to changes in the underlying stock price. Today, if Bed Bath & Beyond's put option has a delta of 0.7, that's great, but maybe next week when the time to expiration is fast approaching, the delta on it might be 0.5, and gamma tracks that change over time. Just like delta, if you're using the married put strategy, gamma is something to be aware of, but it's not that important. Really what we're going to be talking more about gamma, talking about it in depth when we talk about trading calls. The next Greek is a very important one. It's called Theta. Theta tracks the effects of the passage of time. At the beginning of this, I said that I could buy puts that expire on Bed Bath & Beyond, to use this example, that expire, say, in November of 2014 or January of 2015, January of 2016. And the longer I have that insurance on, the more relevant I think Theta becomes to me. Theta expresses the effect of the passage of 1 day of time. We have a put with a strike price of 60 and shares that are currently trading at $61, and there's, let's say, only 1 month left to expiration. So let's say I have a put with a strike price of 60 on Bed Bath & Beyond. Bed Bath & Beyond is currently at $61.05. The thing is going to expire in a month. That means the probability of the Bed Bath & Beyond shares dropping sufficiently to make my put profitable becomes less and less as time passes. And so what we find with Theta is that the change in Theta's value is going to decrease rapidly as the expiration nears. Again, interesting, but for somebody who's going to be just using the married put strategy to protect their capital against catastrophic loss, not that relevant, but it is something I think we need to be aware of, and it's something I'm going to get into in greater depth when I talk about calls. The fourth of our Greeks is called Vega, and Vega is a measure of the extent to which the option is going to change in price relative to the volatility of the underlying stock. That makes sort of sense when you think about it. Imagine you have 2 stocks, both trading at $60, but one moves up and down $10 in a given month, and one moves up and down only $1 in a given month. That $60 stock, let's say we also have a $61 put on each of those stocks. The $61 put on a stock that goes up and down $10 in a day is going to be much more valuable, all else being equal, than the one that goes up and down only by $1 a day, because the probability that the really choppy stock is going to be is going to fall sufficiently in price to make our put profitable is much greater than if the thing just gently floats around. Again, Vega is probably not one of those things that we're going to care too much about if all we do is the married put strategy, but it's something that I want to express to people because we're going to be getting into options in greater depth and you should know what it is. The final Greek that people pay attention to is called Rho. Rho has to do with interest rates. Not that relevant at the moment because central bankers around the world have manipulated interest rates to ridiculously low levels. So it's not that much of a concern for options investors for the next couple of years at least. But basically, if you're interested, Rho tracks the sensitivity of the options price to changes in interest rates. Interest rates are low and probably going to stay low for a little while in my view, and therefore Rho isn't something we need to pay particularly close attention to. As usual, thank you very much for watching. Thank you again to those people who've recently subscribed to us. I'm really quite flattered by the comments that I'm getting, the large influx of subscribers we've had in the last month or so. So thank you very much for that. See you next time.